Hi there, thanks for joining us here at PhillipCapital's Market Watch. I'm Jeremy, CFD dealer from Phillip Securities. In this episode, we'll be discussing whether the Omicron variant and the Federal Reserve will derail the Santa Rally phenomenon that happens in the last month of each year. On 26 November, news of the spread of a new COVID-19 variant, Omicron, in South Africa caused a massive sell-off in financial markets. This shows that COVID-19 remains the main narrative for investors. The World Health Organization, or WHO in short, announced Omicron as a variant of concern because of the high risk of infection and possibility of vaccine evasion. The variant was first identified in Botswana and appears to be responsible for a sharp increase in cases in South Africa, which started rising on 19 November 2021. In the following week, we saw the major indexes sending mixed signals throughout the week as a lack of information about the Omicron variant left markets volatile. It remains to be seen whether Omicron will cause a lasting market rotation or a temporary bump on the road to recovery. As of 3rd December, data from WHO confirmed that the Omicron variant has been detected in 38 countries, but no deaths have yet been reported. Emerging data is suggesting that the new variant is more transmissible, but less severe than past strains. Nonetheless, market volatility is likely to persist in the next few weeks until more facts about the new COVID-19 variant are discovered. Inflation rose sharply in October, accelerating at its fastest pace since the early 1990s. The Fed's preferred inflation gauge, the personal consumption expenditures, excluding food and energy, increased 4.1% from a year ago, the highest since January 1991. Late last month, in an appearance before the Senate committee, the Federal Reserve Chief had a change in tone on inflation and made hawkish remarks where he mentioned that it might probably be a good time to retire the word transitory to describe inflation, as well as the likelihood that tapering could wrap up a few months sooner than anticipated. This would potentially result in interest rate hikes thereafter. On 15 December, the Fed would be discussing about the potential acceleration of the tapering, which is most likely to be doubled from 15 billion per month to 30 billion. Meanwhile, the financial markets have already started to discount a far more hawkish scenario, with the first rate hike now expected in June 2022. And the rising probability of 2 other interest rate hikes in September and December 2022, a whopping total of 3 rate hikes next year. The remarks injected an extra layer of worry to a market already skittish about the emergence of the Omicron variant. With the earnings seasons in the rearview mirror and holiday season afoot, there is ongoing speculation as to whether there will be a Santa Rally this year, a phenomenon that happens in the last month of each year. A Santa Claus rally usually occurs during the last 5 trading days of the current year and the first 2 trading days of the new year. Stocks have returned an average of 2.3% in December since 1936 and generated a positive return 79% of the time. There are many possible reasons for this phenomenon, such as increased holiday shopping, investors being optimistic early in the calendar year, fueled by companies reporting of annual results as they set out positive forecasts for the year ahead, etc. With the uncertainty of the new COVID-19 variant, the change dynamic in the monetary policies and rich valuations in the stock market will most likely create higher volatilities in the financial markets. Therefore, it is hard to ascertain whether there will be a Santa Rally this December. With rising uncertainty in the macro environment, it is therefore important for investors to adjust your positioning to a more cautious stance and be more selective in your holdings as we wait out for a clearer picture. In the equity space, there are few opportunities that investors can look at that are more resilient in these uncertain times. The first opportunity will be investing in quality companies. Quality companies are usually businesses that can generate profits in almost any economic environment. With a strong brand name and products or services that always see steady demand, investors can count on these types of companies through thick and thin. Blue chip stocks are a good example as they are fundamentally strong, with strong balance sheets, stable cash flows, and business models that can withstand the test of time. Some companies you can consider are Google, Facebook, Apple, and Microsoft. While selecting quality companies for your portfolio, it is important to avoid those that are trading at extreme multiples and choose those with reasonable valuation instead. Alternatively, to avoid the hassle of selecting individual companies, you can also choose to invest in a fund that focuses on quality companies, such as the VanEck Morningstar White Mode ETF. The Mode ETF focuses on US companies that possesses sustainable competitive advantages, or moats. These companies have a competitive edge in their respective industries and have historically demonstrated strong pricing power. On a historical basis, the ETF has outperformed the S&P 500 during both bull and bear markets. The second opportunity will be investing in consumer staple companies that provide everyday essentials like food, clothing, and cleaning products, etc. Unlike cyclical stocks that tend to rise and fall with the level of economic activity, consumer staples are less impacted by a slowdown since their goods and services are always in demand, offering investors safety during recessionary climates. Consumer staple stocks are also generally defensive, dividend-paying stocks, meaning they tend to outperform during economic downturns. Consumer staple companies you might consider looking at are Coca-Cola, Walmart, and Costco Wholesale. Alternatively, you can also invest a fund that offers exposure mainly to the consumer staple sector, such as the Consumer Staples Select Sector SPDR Fund and iShares US Consumer Staples ETF. And that's all for today's Market Watch. Do remember to like and follow us on social media, or subscribe to us on YouTube. Thanks for joining us and see you soon.